you a new investor looking for strategies to grow your wealth? You're in the right place. Today, we're going to tackle the exciting world of investing, and more specifically, we're going to focus on strategies tailored for those who are just dipping their toes into the investment waters. Investing is a fantastic tool to increase your wealth over time, but like any tool, it's most effective when used with a clear strategy. From setting clear financial goals and building an emergency fund to diversifying your portfolio and seeking professional advice, there are many strategies that can guide your investment journey. So, whether you're investing for your retirement, a major purchase, or simply to grow your wealth, these strategies will give you a solid foundation to start from. So buckle up and get ready to take notes. In the next 15 minutes, we will break down these strategies into clear, easy-to-follow steps. Firstly, define your financial goals. That's right, the journey of investing begins long before you buy your first share. It starts with setting clear and realistic financial goals. These goals might revolve around retirement, making a major purchase, or simply growing your wealth. By knowing what you're striving for, you can tailor your investment strategy to meet those specific goals. For instance, if you're investing for retirement, you might lean towards a more conservative approach with low-risk long-term investments. If you're aiming for a major purchase in the shorter term, your strategy might involve a mix of high and low-risk investments. And if your goal is simply to grow your wealth, you might take on higher-risk investments for potentially higher returns. Remember, no two investors are alike, and your goals won't be the same as the next person's. So, align your investing approach with your unique financial aspirations. Your goals will significantly influence your investment strategy. Before you begin investing, ensure you have an emergency fund in place. This isn't just a friendly suggestion, it's a cornerstone of any solid financial strategy. Life is unpredictable. Cars break down, medical emergencies occur, jobs disappear. When the unexpected happens, an emergency fund is there to save the day, preventing you from dipping into your investments or incurring debt. But how much should you squirrel away? A good rule of thumb is to cover at least 3 to 6 months' worth of living expenses. This provides a buffer against life's curveballs, granting you the peace of mind to invest with confidence. Remember, this fund isn't for vacations or luxury purchases. It's your safety net, your financial backstop when life throws a wrench in the works. Treat it with respect, keep it replenished, and it will serve you well when you need it most. An emergency fund serves as a financial safety net. If you have high-interest debt, consider paying it off before investing. Now, what's the reasoning behind this piece of advice? Well, high-interest debt like that from credit cards can eat into your finances at an alarming rate. It's like a leaky bucket. No matter how much water you pour in, if you don't plug the hole, you'll never fill it up. Let's put this into perspective. Suppose you have a credit card debt with an interest rate of 20%. Even if you manage to achieve an impressive return of 10% on your investments, you're still effectively losing money. Why? Because the cost of your debt is outpacing the return on your investments. This is why it's often more beneficial to eliminate high-interest debt before starting to invest. By doing so, you're essentially giving your future investments the best possible start. Remember, the interest on such debt can be much higher than what you might earn through investments. Diversify your investments across different asset classes to reduce risk. Now, what does this mean? Picture your portfolio as a basket. If you put all your eggs into one basket and it falls, all your eggs break. But if you spread your eggs across different baskets, a fall in one won't break all your eggs. That's the idea behind diversification. It's all about spreading your investments across various asset classes like stocks, bonds, real estate, and more. This strategy helps to manage risk. Why? Because different asset classes often perform differently under the same market conditions. So, if one asset class is doing poorly, another might be doing well, balancing out your overall portfolio performance. This strategy doesn't guarantee profits or protect entirely against loss, but it can help to smooth out returns over time. Remember, diversification helps protect your portfolio from the ups and downs of individual investments. For new investors, it's often wise to begin with a simple, low-cost approach. This strategy is not only friendly to your pocket, but it also allows you to learn the ropes without too much at stake. Now, You might be wondering, how does one do that? Well, consider investing in low-cost index funds or exchange-traded funds, also known as ETFs. These funds aim to mimic the performance of a specific market index. For instance, an index fund tracking the S&P 500 would strive to mirror its performance. This approach provides a broad market exposure, thus spreading out your risk. It's kind of like having a slice of every company in the index. The beauty of these low-cost funds lies in their simplicity and affordability. They usually have lower expense ratios compared to actively managed funds, meaning more of your money goes into the investment, not fees. So, you see, these funds offer a cost-effective way to gain exposure to the stock and bond markets. Consider dollar cost averaging rather than trying to time the market. Now, what does this mean? Dollar cost averaging is a strategy that involves consistently investing a fixed amount of money at regular intervals. This could be weekly, monthly, or quarterly, depending on what suits your financial situation best. What's the benefit of this approach? Well, by investing the same amount regularly, you buy more shares when prices are low and fewer shares when prices are high. This approach can take the emotion out of investing and help you avoid making impulsive decisions based on market fluctuations. Remember, the stock market can be unpredictable. It's virtually impossible to consistently buy at the lowest point and sell at the highest point. By sticking to a regular investment schedule, you can manage the impact of market volatility and potentially lower the average cost per share over time. In essence, dollar cost averaging allows you to play the long game, focusing on consistent growth rather than short-term gains. This strategy can help smooth out the impact of market volatility. Investing is generally a long-term endeavor. This statement is the backbone of successful investing. It's essential to understand that investing isn't about making a quick buck, but rather about growing your wealth over a sustained period. When you're traversing the landscape of investments, you might come across the tumultuous terrains of market volatility. These short-term market fluctuations can be unnerving, causing some to panic and make hasty decisions. But remember, these fluctuations are just part of the journey. Historically, markets have a tendency to trend upward over time, despite the occasional dips and dives. It's like sailing across a vast ocean. There will be waves, there will be storms. But if you keep your compass steady, you can navigate towards your destination. The key is to remain focused on your long-term objectives. Don't get swayed by the short-term turbulence. Keep your eyes on the horizon and your hands steady on the helm. Don't let short-term fluctuations derail your long-term goals. While it's not necessary to become a stock market expert, it's important to have a basic understanding of your investments. This understanding is more than just knowing what you've invested in. It's about staying current with news, trends, and insights that could influence your investments. Consider this. Investing is like setting sail on a vast ocean. You wouldn't venture out without a clear understanding of the weather conditions, would you? Similarly, the financial market has its own ebbs and flows, storms and calm seas. To navigate it successfully, you need to be aware of these changing conditions. Staying informed about the companies or funds you've invested in helps you make wiser decisions. It's about knowing when to hold on, when to let go, and when to explore new opportunities. This doesn't mean you need to be glued to the financial news 24/7, but rather, make it a habit to periodically check on your investments and the market conditions. So remember, keep yourself informed about the companies or funds you invest in. Be mindful of the tax implications of your investments. This wisdom rings true in the world of investing, where every decision can have a tax-related consequence. Investing isn't just about growing your wealth, it's also about managing your tax liability. So what is tax-efficient investing? Simply put, it's a strategy that aims to minimize the amount of taxes you owe on your investment gains. This is where tax-advantaged accounts come into play. These are special types of investment accounts that offer tax benefits like individual retirement accounts, IRAs, or 401(k)s. With these accounts, your investments can grow tax-free or tax-deferred, meaning you either won't owe taxes on your investment gains, or you'll delay paying taxes until a later date. This can provide a significant boost to your overall investment returns over the long term. In the end, it's all about making smarter decisions that align with your financial goals, while keeping Uncle Sam's share to a minimum. Utilize tax advantage accounts such as IRAs and 401ks to minimize your tax liability. Periodically review your investment portfolio to ensure it aligns with your goals and risk tolerance. Now let's talk about rebalancing. Imagine a seesaw with your investments on one end and your financial goals on the other. Over time, the seesaw may become unbalanced due to market fluctuations, changes in your goals, or variations in risk tolerance. That's where rebalancing comes into play. Rebalancing is the process of adjusting the proportions of your portfolio back to your original asset allocation. It's like a tune-up for your investments, helping you stay on track with your financial objectives while managing risk. So, how does one rebalance? It's a two-pronged approach. First, it involves selling off investments that have grown beyond their intended proportion of your portfolio. These are your winners. Second, it involves buying more of the investments that have shrunk below their desired proportion. These are your losers. Rebalance by selling some of your winners and buying more of your losers to maintain your desired asset allocation. Remember, rebalancing is not about chasing returns, but about sticking to your financial plan. If you're unsure about how to invest, consider consulting a financial advisor. These professionals can be invaluable assets on your journey to financial growth. They offer help tailored to your unique financial situation, considering your risk tolerance and goals. Navigating the world of investing can feel like trying to read a map in a foreign language. A financial advisor serves as your translator, turning complex financial jargon into actionable advice. They'll guide you through the labyrinth of stocks, bonds, and funds, helping you understand the potential risks and rewards. Moreover, they can assist in devising a comprehensive financial plan. They'll consider aspects beyond just investing, such as retirement planning, tax strategies, and estate planning. It's like having a personal trainer for your finances, providing you with the tools and strategies to optimize your financial health. Remember, the goal of investing is not just to grow your wealth, but also to secure your financial future. A financial advisor can provide personalized guidance to help you navigate your investment journey. You may make some investment mistakes along the way. That's okay. The road to investment success isn't always smooth. It's punctuated by bumps and potholes that can sometimes throw us off course. But here's the thing. These mistakes, they're not signposts for failure. They're invaluable lessons that can guide us toward better investment decisions in the future. Think of it this way. When a toddler takes their first steps, they stumble, they fall. But with each fall, they learn, they adjust, they get better. The same principle applies to investing. Each stumble is an opportunity to learn and improve. Maybe you bought a stock based on a hot tip only to see it plummet. Or perhaps you let emotions drive your investment decisions, leading to impulsive buys or sells. These are common mistakes, but they are also rich learning opportunities. They can help you refine your investment strategy, making it more robust, more resilient. The key is to learn from those mistakes and continuously improve your investment strategy. Remember that no investment is completely risk-free. It's a fundamental truth that underscores the importance of the strategies we've discussed today. From setting clear goals and building an emergency fund to paying off high-interest debt and diversifying your portfolio, these steps are vital to your investing journey. We've also talked about the merits of a simple, low-cost approach, the principle of dollar-cost averaging, and the importance of maintaining a long-term perspective. Staying informed, considering tax-efficient investing, rebalancing your portfolio, and seeking professional advice are equally crucial. And let's not forget the value of learning from our mistakes. These strategies are not just tactics. They form a comprehensive approach to investing that can guide you in navigating the financial markets. Remember, the goal is not to eliminate risk, but to manage it effectively, balancing potential rewards with your risk tolerance and financial goals. As you gain experience and knowledge, you can fine-tune your investment strategy to suit your specific needs and preferences.